Okay, we're not going to talk about robots. So tactical high income, is that the right name for the fund considering rates are coming? Like, is it really relevant anymore? Like, Adam, tactical high income, tell us about it.
Yeah, tactical high income definitely is tactical, and you can look at the history of the fund and what we've been doing. The fund is an alternative to a traditional 50-50 fund, an alternative to a 40-60 fund, 60-40 fund. We're giving you a balanced approach to investing, but with some really interesting mispriced securities in there. Our best ideas from Fidelity from across the entire spectrum, from treasury bonds on one end to dividend-paying stocks on the other, and everything in the middle. And that everything in the middle are things that's our competitive advantage at Fidelity with our analysts in the high income and alternatives group that are looking at from a bottoms-up perspective: preferred shares, convertible bonds, high-yield bonds, loans, emerging market debt, floating rate debt, investment-grade corporates. And when you look at the performance of all these trillions of dollars of assets that are in our universe, they all take turns as the best and worst performing asset class in any given year. The market has a tendency to rightly or wrongly price in risks, only to get adjusted the following year when the actual events occurs. So we just wait for the opportunities to come our way and find our best ideas. And the raison d'etre of this fund is that the difference between the best and the worst performing asset class in any given year could be thousands of basis points. A majority of the time over the last 25 years, it's been something other than investment grade bonds or S&P 500 stocks that have been the best performing asset class. So if we can regularly and consistently look at all these other asset classes that our peers are not, we can really deliver an attractive risk reward. So, and many different income-oriented asset classes. So we have a duplicable and repeatable process that we'll talk about today.
So even with reducing interest rates, you're able to find yield because you've got capital growth, but you've also got that high income component as well. And that's because of all these different asset classes that you can explore. So talk about the risk controls.
Yeah, so our risk controls are that we can't be less than 30% in stocks. We can't have more than 60% in stocks. So think about us as having, through a full investment cycle, 45% in stocks. And the proof is in the pudding, Glenn. Like, we've only been overweight equities 1 year, and overweight equities would be over 50%. And that was after the COVID crisis in 2021. We've been averaging in the 40s on equity. So that's number one. That's bucket number one. That means that we can have 40 to 60% in fixed income. The mix of the fixed income, whether it's a preferred share, a loan, a high yield bond, investment grade corporate, we'll talk about that in a second. Relative to there's no benchmark on this fund, but we're sort of modeling. We want to wiggle around the traditional 50% S&P 500, 50% Barclays Aggregate Index, which is the U.S. index. That's a 3-year duration. So relative to that 3-year duration, investment grade duration, we can't be more or less than 1.5 year overweight or underweight. And we can do that through different ways. So that's rule number 2. And then number 3 is that we want to have a big premium yield. So we want to have a premium yield that hundreds of basis points, 150, 200 basis points on average, more than what you'd get in a traditional balance fund. And that is a really key component. We want to be very tax aware as well. So if you look at us on an after-tax basis, you'll see a very tax efficient strategy. We have the flexibility. We want to have very tax efficient turnover, and that's key.
A couple of minutes ago, you talked about increasing your equity exposure after, I think you said, the financial crisis or situations like that. Scott, talk about, I forgot the phrase you used, jumping into the fire in the past, but the opportunity that presents itself, you're there.
Exactly. Yeah, we say, walking into the fire, mopping up the floor maybe is a little bit less crazy, I guess, the sounding. But yeah, when we looking, we, as Adam said, we've been underweight equities for most of the life of the strategy, for the exception of 1 year. But when you get a situation like we had in April, and if you look at our portfolio, we've been underweight some of the largest names in the S&P 500. A lot of the names that you've heard folks talk about today, the NVIDIAs of the world, et cetera. And again, they don't have a lot of income, but we have them in the fund because we want to give the experience of that 50-50 index. And in order to do that, you're going to have to own some of them. But when you see these episodic sell-offs like we saw in April, and we were out in Vancouver during that period of time, but there are a bunch of analysts that were actually on their way to and portfolio managers to Seattle to talk to a lot of these companies about what was going on with AI and those sorts of things. And as we were getting the information in real time from one of our co-portfolio managers who was there, we said, okay, this is still happening. these stocks have sold off. Let's close or reduce these underweights a little bit. And then that has been great, obviously, for our fund over the last 6 months or so. But the other things we were doing is, a lot of people have talked about the valuations being very rich and everything's priced for perfection. But, we're style agnostic. You'll see growth stocks in here. You'll see small cap stocks. You'll see some foreign stocks. You'll see value stocks. So we don't really care what type of, label it gets put on it. If there's value and there's good downside protection, we'll go after it. And what we've been saying for a while and where we started to add more was in small and mid cap stocks. While the rest of the market has recovered and priced at very high levels from a valuation perspective, there's parts of the small and mid cap stocks that still are pricing in a recession. And that's where we started to look as well. So in some of those small and mid cap names, and they've done quite well, we can talk about those. We also started looking at some of the financials too. This is an area where everybody forgot about banking deregulation as part of the Trump plan when he came in last November. And, we're starting to see that happen and playing out in some of those companies as well. So those are some of the different areas that we kind of looked at from a new perspective post that kind of crisis. But it also gives us time, when you have these periods of volatility and you have positions that are in the top of the portfolio, you want to know, should I buy more? And Will was talking about that, a little bit earlier. If there's a stock that you like and it goes down, well, you should buy more of it. So what we did during that period too is we met with a lot of these companies. So we met with some of the utility companies in Alberta that we have positions in. We talked with some of the tanker companies, as those have been big positions within our portfolio. So gaining the conviction and saying, okay, nothing has changed as a result of this volatility. We'll either add here or maintain our position. And those are the types of things we were doing during that volatile period in April, even if it was a little short period of time.
Adam, what's with tanker stocks? That's a long time thing for you?
Yep. Tanker stocks have been in the portfolio since we started. I've been, like you say, I've been covering this industry for 25 years. That was my first industry that I covered at Fidelity.
When you were an analyst, you covered tankers, among other things.
Yeah.
And it stuck with you.
Yeah, and back then it was a horrendously badly managed industry. It was always boom bust, a lot of debt, free cash flow break even, and a lot of these names have found religion. And so what I think key theme that you'll hear from us today, a lot of the names we just like to wait for the opportunities to come our way. Is there a cyclical story where we think we're in mid or late cycle, but a lot of these bonds or stocks, whatever it is pricing in a recession? Or is there a secular story where the industry just has a bad rap from years ago, decades ago? Now, with the tankers, the oil tankers are refined product tankers, and I've spoken to the channel about this many times over the last number of years. These are basically floating pipelines. They transport oil or refined product from point A to point B. But whenever there's disruptions in the world, it causes the supply to come out of the system. And of course, demand is driven by oil demand and what OPEC is doing. Now, what's secularly changed with these names is that a lot of them have paid down their debt to below scrap values. They've brought their free cash flow break-even rates to below cycle trough. So they actually can generate free cash flow, at the trough. So that's just something you didn't have before. And now, because there's been so many ships that are older that are being operated in what they call the shadow fleet by Iran or Russia, there's good 14% or so of the supply that could eventually come out of the system if there ever was peace. And that's what's now priced in as well. In the meantime, these companies have changed their dividend policies. They're paying out either 75 or 100% of their dividends to the shareholders. So what a great thing to have in the fund for an income perspective. They do well when there's geopolitical risk. Like, for example, today there was a headline that that India is no longer going to be importing oil from Russia. That's very good for the tankers. OPEC's increased production, very good for the tankers. When you look at how much they can pay out through a full cycle, it could be anywhere from 4 to 20% of dividends. So what it is a great way to win in multiple scenarios. A secular story that's still not figured out by the industry. And if you look at the cumulative returns of the U.S. traded oil tanker names, many of which are in the fund, a couple are in the one or two are in the top 10. You'll see that they're not only beating the Nasdaq in some periods, but definitely has been the place to be in the energy space over the last number of years.
Can you, Scott, talk about the team that you work with as far as award winner Ford O'Neill and award winner Ramona Prasad helping on the fixed income and the equity side?
Yeah, it's a little bit of a unique structure the way we have things set up for this fund, where Adam is the lead portfolio manager and makes all the buy and sell decisions in the strategy in terms of what goes in, what comes out. The way we lean on Ford and Ramona is to get their insights into the asset classes that they are focused on. So obviously Ramona with dividend paying equities, and Adam and Ramona have a relationship outside of this fund within what we call the Strategic Dividend Income Fund in the U.S., where she manages actually a sleeve of dividend paying stocks for us. So she gives us ideas there. Some of the ideas that have made into the portfolio from her recently have been some of the non-U.S. like the London-based pharmaceutical companies, really attractive valuations relative to some of the other things out in the market. So she'll kind of inform us on what her views are of the market, where she's finding opportunities, and we'll go comb through those ideas and try to plug them in. I think, and on Ford's side, we talked about the middle part, the high yield bonds, the loans, convertibles, preferreds. That's our area of expertise. But investment grade bonds and emerging market debt to some degree, maybe not our bailiwick, and that's where we rely on Ford. Ford will tell us, hey guys, I'm looking at XYZ company today. It's a really good value. I think it's a good something that we should consider for tactical high income. So he'll give us his kind of views on the market, and anything you see happening on the investment grade side of the portfolio, there's usually some sort of Ford O'Neill fingerprints kind of on it. So for today, for example, whenever credit spreads within the IG space get really tight, and there's not much to do there, we'd rather just take the least amount of capital to build out our investment grade duration. So what he's been saying is, hey guys, investment grade spreads are at historical tights. It probably makes the most sense to let's just use 15% of the portfolio, buy 30-year treasuries. We get the investment grade duration that we need, and then we can use the balance that other, if you think of a traditional balance fund, 50% is in the aggregate bond index. Here we're only using 15. Let's take that 35 and we can invest it in things like high yield credit, loans, convertibles, preferreds, et cetera. So the way I think about it is when you put the four of us in a room, Adam, myself, Ford, and Ramona, you have the full spectrum of income-oriented asset classes of folks that are looking at it on a day in and day out basis. Some other funds out there, they might allocate to these areas of the market, but they don't have that full spectrum represented from a portfolio management team. And we have these regular ongoing discussions, not just systematically. Every quarter we have to meet. There's things happening every day back and forth to give us these insights on where we think there's good value and income.
So you're analyzing a company from all levels of the capital structure.
Exactly.
And when a company comes in to speak with you and your team, they're getting questioned from all angles of the capital structure. It must be pretty intense.
It can be. There's, for us, the way I think about it, the simplistic way I think about it, Will and his team, they talked about earnings, right? Stock prices follow earnings. So they're really interested in earnings growth, what's happening with earnings, and from our perspective as debt investors primarily, it's, are we going to get our money back, right? So we could have a company that is maybe not growing as fast as maybe Will would like, but it's still generating enough free cash flow to pay its debt down. That might be something that's attractive to us. But when you get, so there's different kind of focuses of the analyst team. And when you get a management team in-house, I often say, they're some of the best salespeople out there. They're not going to lie to you, but they're going to tilt their discussion towards the audience. So, for example, you could have a situation where an equity analyst is asking questions about potential acquisitions, and all of a sudden the management team says, "Oh yeah, we're thinking about doing X or Y, maybe buying this company," and the debt folks are saying, "Whoa, whoa, whoa! I thought that cash was going to delever. Are you sure that's something you want to do?" Right? So you get this more balanced discussion, and there's less kind of ways for the management teams to wiggle around questions. And there's very few places in the market from an asset management perspective where you can get both sides of the balance sheet, and even sometimes you can get an investment grade analyst, a high yield analyst, an equity analyst having this active discussion with the portfolio management team, which we think gives us a lot of different perspective and gets more information out of that meeting than if you just had the equity analyst sitting down with a management team.
I'll just add one more thing on that, just to synthesize it. I always look at a bond can go up in value just like a stock. You can get principal appreciation. So I always like to say, what is the company's ability plus intent to improve the credit metrics of the company? So the ability would be, what are the 12 to 36 month fundamentals? That's what you can get out of sitting in on the equity meetings. What is their ability to generate free cash flow? And what is their intent? Are they going to invest it in are they going to pay down debts? Are they going to make acquisitions? And those are the type of things that can really, differentiate the stock versus a bond. And that's the main ingredient for trying to find what we like to call the sweet spot in the capital structure. What part of the capital structure has the best risk reward? Because I mentioned at the beginning of the initial question that you had, all these asset classes take turns as the best and worst performing asset class in any given year. You could have a stock versus a bond in the same company's capital structure that are performing very differently. And so that's what we're trying to find.
So if I visualize your fund, Tactical High Income Fund, it's connected to a balanced fund, which you've talked about before, but it's way more diverse. It's around 40 or so % equities right now, but the remaining is diversified beyond what many people can imagine because of all the resources that you have. And one of the, and it's run with great risk controls. One of the aspects of it, which you apparently are the king of, are convertibles. And I don't know if you drive a convertible, but you should if you don't. But you've been a convertible aficionado for like your whole career.
Yeah.
Why?
Yeah, convertibles and I go back a long way. So going back to the oil tankers, back in 2002, I think it was an oil tanker company that did a convertible, and that's how I sort of got to know the convertible bond market. So for anybody who's not familiar with a convertible bond it's a bond. So you're promised to be paid back at 100 cents on the dollar at maturity. But unlike other bonds, it's the only type of bond where you can double, triple, quintuple, or as the case with Tesla, or now a company called Rocket Lab, where you
Rocket Lab?
Rocket Lab is a 14-bagger. It's in the index today. It's one of the largest.
They make rockets?
Convertible index. It's a competitor to SpaceX, basically. They issued a convertible at 100 cents on the dollar, trading around 1,400. Eventually, it would just get converted into equity and leave the index. So the convertible bonds, for us, the convertible bonds are the secret sauce of the fund. And with convertibles, we like to buy it because you have your downside is capped because eventually you just become a bond. But if you participate in the equity, you can eventually become equity, and you can participate, with the equity eventually. So what our competitive advantage is that I manage the convertible bond fund with another co-manager named Rick Gandy in the United States. The Fidelity Convertible Securities Fund is sold in the United States. We look at every single new convertible bond deal that comes to the markets. And we like to look at the convertible bonds as like a basket of kittens. The kittens come to us. We never, it's always like a different narrative every year. What's the theme going to be? And the kittens, 1/3 of them historically have become what we call these lions, those Teslas, the NVIDIAs, the Rocket Labs, the multi-baggers. And so we're just trying to find the best ideas that we have in our convertible securities fund. And if we like that name, risk reward perspective, upside potential, we'll now overweight in the convertible securities fund will find its way into this portfolio. And that's a way for us to toggle the equity risk above 50% without taking on that equity. Would not have been able to predict it, but year to date, the convertible bond market is the best performing asset class. The last time it was beating the S&P 500 was 2020, when it was 2.5 to 1. And the reason why it's doing so well is that we've actually had a lot of companies they were Bitcoin miners that had electricity locked in the United States. And these Bitcoin miners had this hidden asset, electricity, and they eventually said, we want to change our business model from a Bitcoin miner to becoming a data center for artificial intelligence. And when they came to the market in November of last year, September of last year, these names were trading at 3 or 4 times enterprise value to EBITDA because nobody believed that they can execute. If you look at some of the data center REITs in the United States, they're trading at 20 times. So we've had this revision, multiple revision. Oil tankers, multiple revision. We'll talk about Alberta, IPPs, multiple revision. Bitcoin miners, multiple revision. And a lot of these secular themes find their way to the convertible market for whatever reason. It's always a different theme year in, year out. And that's because we're like looking at this on a regular and consistent basis, this makes this duplicable and repeatable. We're not always going to we're going to make mistakes. We're not always going to get the winners, but this is a great tool to have.
Hello, investors. We'll be back to the show in just a moment. I wanted to share that here at Fidelity, we value your opinion. Please take a few minutes to help us shape the future of FidelityConnects podcasts. Complete our listener survey by visiting fidelity.ca/survey, and you could win one of our branded tumblers. Periodic draws ending by March 30th, 2026. And don't forget to listen to Fidelity Connects, The Upside, and French Dialogue Fidelity podcasts Available on Apple, Spotify, YouTube, or wherever else you get your podcasts. Now back to today's show.
Adam mentioned Alberta. Do you want to talk about what's going on there?
Yeah, sure. And we mentioned a little bit of the what's happened in the U.S. and the demand for electricity, and why a lot of these Bitcoin miners have done really well, because they're transitioning to data centers. And as you've heard today, there's a shortage of electricity in North America and the United States. And one of the areas where there is the ability to generate more electricity is in Alberta. You have the commodity up there. You have unregulated utilities. You have power plants that are underutilized and mothballed in many instances. So the ability, and you have the transmission lines, not across Canada, but even down into the States. So this is an area that if there was ever to be some deal signed, we would see a re-rating of these multiples for these stocks in Alberta. And we've started to see that happen as there's been more news around potential deals being struck up there as it relates to data centers. So that's why we went in and have created these large positions. But the way we found out about it, Glenn, was when they were issuing preferreds and convertible and high yield bonds in US dollars. And that's when our analyst Gavin, who covers these for us, was like, hey, these look pretty interesting. And he had covered the ones in the US and saw exactly what I'm talking about, the re-rating of some of these Texas independent power producers. And he said, look, we've got this very similar story here. The market was still viewing Capital Power and TransAlta as very highly levered businesses, but they had done a lot of the same things that Adam was talking about with the tankers. They had reduced debt, had very flexible balance sheets, so the market was still viewing them as highly regulated or highly levered in a not great market, because the spot market has been pretty soft up there. So we put all these things together, great valuation. Our analyst understands where these things could go based on what he's seen in the similar industry in the U.S. So we started to add to those, and as I said, when we were in Calgary in April, went out and visited them, just popped in, got to know the management team a little bit, and said, okay, this makes sense. Let's buy some more of this, and we'll see what happens, because we could just get paid to wait. Because at that point, there was the dollar blowout, so we had some Canadian dollar exposure there that looked really attractive. The company itself was doing fine because it had delevered, as I had mentioned, and then we have this catalyst of the data centers, which is starting to play out. So that's kind of how we found those companies, was through the issuance of high yield bonds. And again, we wouldn't have found these companies if we weren't sitting in our group.
Yeah, we have a great analyst in our group, Gavin, as Scott was mentioning, who covered the IPPs in Texas, the unregulated utilities in Texas, and then eventually, like whatever he learned with the utility companies in Texas, moving on to data centers, he was able to translate it into what was happening in the convertible market, and then Alberta, which is an unregulated market as well. So to what Scott's saying, the spot market in Alberta was very depressed. The capacity utilization of these plants was very depressed. They had a lot of land, and eventually they could sign long-term deals. That's secular changes, if any of that happens, not priced in at the time, and we still hold these, and we're waiting for something to happen if it does. But even if it doesn't, our entry point was a good level as well.
Good stuff. And the 30-year, Adam, that's been in the portfolio for quite a while.
Yeah. So this is where Ford O'Neill, my co-manager, and I work with Ford O'Neill on a bunch of other asset allocation funds in the United States. $25 to $30 billion worth of asset allocations, where we allocate money to different fund managers within Fidelity in 18 different asset classes. That's where I get a lot of my ideas as well, from REITs or international equities or whatever, international bonds. But Ford O'Neill for anybody who doesn't know, he's one of the most successful bond managers in the United States. He manages a lot of money. The Fidelity Total Bond Fund's an award-winning fund. I think he was Fixed Income Manager of the Year for Morningstar a couple years ago. So being able to work with Ford O'Neill was like working, like hearing Nidhi and Matthew talking about Will. As Ford O'Neill is just an unbelievable investor, a mentor, and has so many different playbooks. And one of the playbooks that we have in this fund that you might hear about from Mike Plage tomorrow, because Mike Plage works with Ford O'Neill as well, is that when investment grade bonds are very tight, when the spreads are very tight, and the market is pricing in late cycle or not early cycle, you probably want to focus on building out that investment grade duration with the least amount of money as possible. That's the 30-year Treasury, because the 30-year Treasury, if let's just say 50% of a balance fund would be in investment grade bonds to build out a 3-year duration, I can build that out with 15% in the most discounted 30-year bonds. And then I could take that other 35% and put it into high yield bonds, credit, preferreds, all these other things we're talking about. That really acts as a downside dampener in down market. So it's more of like an insurance policy. It tracks 50% of the investment grade bond market. Even during Liberation Day, did a pretty good job tracking it when Treasury rates were selling off. But it actually allows us to have that insurance policy. So like a day like today, I think the market was down a lot. Rates are moving lower. Our 30-year Treasury is doing pretty well. Money will flow to the 30-year Treasury in a really bad environment. And that's the reason why we have that. And we just don't see much value in investment-grade corporates right now, or for that matter, fixed-to-floating subordinated debt, which was a top idea of ours a few years ago. Many of the investment-grade corporates are very rich from a spread perspective. So that's why we have the 30-year. I'd say we're probably a quarter of a year underweight investment-grade duration.
Okay.
And then we're probably 3/4 of a year overweight credit. So half a year overweight credits, overweight duration on the margin.
And Scott, collateralized loan obligations?
Yeah, so that's one of the other tools.
CLOs is much easier to say.
Yeah, CLO is much easier to say. Again, not a huge piece of what we do, but I think it goes to the depth and the resources that we have at Fidelity. So for those that don't know, CLOs are a huge part of the leveraged loan market in the United States. So 70% of all leveraged loans in the United States are owned by CLOs. So CLOs is a structured credit product. And what's interesting about it is that when we look at the CLOs, they're investing in the same loans that our loan funds are investing in, but what they do is they create options for investors to buy different credit tiers, right? So the CLO structure will have AAA notes, AA notes, single A notes, double B notes, etc. And what we found is that in many of these CLOs, the double B rated notes, right? So these are higher quality than the broader high yield market, and the loan market actually trade at a 200 to 250 basis point yield premium versus those asset classes. So for us, this is just another tool. Not a huge piece of what we do, but when you're getting a 10% yield and it's only 40 or 50 basis points of the fund, any incremental income can help us. And we've got an analyst, Michelle, who has been in that market for many, many years. We actually, within the group, issue CLOs ourselves, so we understand those markets. And Michelle meets with these different managers, makes sure she understands their style, understands the risks that they're taking in the portfolio. We get comfortable with that, and then we can put them in and add that incremental yield into the fund. And that's what we're trying to do, is use that full spectrum of opportunities at Fidelity to get the best ideas in the fund. CLOs, the focus on the best ideas in the loan portfolio, emerging market debt, like all of these pieces. It's really just finding the sweet spots within those asset classes to make things work.
Yeah, and I'll just say a couple of things, like in terms of preferreds, preferred stock, very rich part of the market now. It's I think it's the worst performing asset class year to date. We've really brought that down. But one of the things where we've been investing in is the strategy of perpetual preferreds. This is
the company strategy.
So the sweet spot in that cap structure is the perpetual preferreds, because you're able to get 10.5% yields for a perpetual preferred that is backed by Bitcoin. There's probably a loan to value of 15%, so very well covered. And what's interesting about it is that it's not. I don't know how we have to check to see what the taxation is in Canada, but in the United States, this is not taxable as a dividend. It's a return on capital, sort of like MLPs. So when you get the income, it actually adjusts back to your cost base. A very, very attractive way to beat the preferred index, and that's sort of where we focused on that. Small caps is an area, like we were saying, has had a lot of bad news priced in. I sprinkle the portfolio with a lot of 10, 15 basis point positions that can become multi-baggers. One of our top attributors year to date was a retail company in Canada that was a 5-bagger. And, I'm basically sitting in a store with my daughter, and that's how I came up with the idea. I mean, some of these things just fall in your lap. So there's a lot of seeds in the portfolio.
Story.
Exactly.
Yes, exactly. So a lot of these things just, we like to sprinkle the portfolio with a lot of interesting ideas. Some have dividends, some don't. But with small caps, I have found that interest rates and all these risks get priced into the small caps. They're sort of the whipping area of the market. So that's where we can find a lot of interesting ideas now.
I like what you said about sprinkling lots in, and the thing is, it's not finite. There's lots more that can still go into the portfolio, and there are other asset classes we didn't talk about today. It's extremely diversified. It's an award winner because of the risk controls and the tax controls too, and it just sounds like a wonderful complement to pretty much any portfolio, especially those that are quite levered a certain direction.
Yeah, exactly.
And I'm supposed to go through 5 quick questions, but I don't know that we have time. Not sure if I'll lose my job if we don't go through them, but I should wrap. Thank you so much for being here, Adam and Scott.
Thanks.
Tactical High Income. Thanks, everybody.
Thanks for watching or listening to the Fidelity Connects podcast. Now, if you haven't done so already, please subscribe to Fidelity Connects on your podcast platform of choice. And if you like what you're hearing, please leave a review or a 5-star rating. Fidelity mutual funds and ETFs are available by working with a financial advisor or through an online brokerage account. Visit fidelity.ca/howtobuy for more information. While on fidelity.ca, you can also find more information on future live webcasts. And don't forget to follow Fidelity Canada on YouTube, LinkedIn, and Instagram. We'll end today's show with a short disclaimer. The views and opinions expressed on this podcast are those of the participants and do not necessarily reflect those of Fidelity Investments Canada ULC or its affiliates. This podcast is for informational purposes only and should not be construed as investment, tax, or legal advice. It is not an offer to sell or buy, or an endorsement, recommendation, or sponsorship of any entity or securities cited. Read a fund's prospectus before investing. Funds are not guaranteed. Their values change frequently and past performance may not be repeated. Fees, expenses, and commissions are all associated with fund investments. Thanks again. We'll see you next time.